Hi, my name is Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I am thrilled that you're here. And I know you're going to get tremendous value from the gentleman I'm interviewing today. His name's Pimm. And he's with Stonemark Landing, stonemarklandings.com, and he's been involved in over 4,500 doors. And he's a bear like me. We had a little discussion about that before we started recording. So, buckle up because you're going to hear how bad it's going to get, but you're also going to hear how excited we are about the opportunities that are coming. So, welcome to the show, brother.
Thank you.
Yeah, let's have some fun. So we met at IMN, right?
That's
the
right.
Mid-Market Conference in Atlanta or Charlotte. Where was it?
Atlanta.
Yep. And I really liked what I heard. I don't remember if we were just from a discussion or if you were on a panel. I think you were on a panel, weren't you?
I was on a panel.
Yeah.
Spreading the same bearish news that
right.
About
Doom
at
and
the time.
gloom, doom and
Yes.
gloom. And there was a lot of sweat on brows there, I'm going to tell you.
There were.
Okay. And so, why don't you, before we get rolling here on the questions, just kind of give us an overview on your background.
Sure.
Did you start in real estate? If not, what did you do briefly before then? Then why real estate? Why multifamily? Did you start in single family, go to multi? Just give us a little of your history.
Sure.
Yeah.
I went to college. I majored in business. I got my BBA from Goizueta University at Emory University with a focus in real estate marketing and management.
Okay.
As I got out of school, my first job was actually to be a financial advisor, which was away from the action that I wanted to be a part of. So we were tailoring investment plans that we could minimize people's...
This was one of the big houses?
Yes.
Yeah,
yes,
gotcha.
Yep.
Mm-hmm.
And so we were tailoring financial plans and minimizing downside risk, trying to maximize upside. But ultimately, there wasn't enough control there in the equities market, right? You're investing in other people executing.
And when was this that you were doing the financial planning stuff?
2005 to 2007.
Okay. Oh,
Yeah.
That's a interesting time frame right there.
Very interesting.
The world was in, oh my God, this is going to last forever. It's going to be in crate. Real estate's the best thing ever.
That's right.
And then 2008.
Yeah, and so it's an interesting time to pivot into the commercial real estate side of
Perfect timing,
things.
actually.
Yeah.
Wow.
So, my commercial real estate career was born in a very tumultuous time.
Yeah.
Yes, thank you. Yeah, and so, I learned how to work through challenging deals and how we, execute on.
So
a
you
business
started acquiring in what, 2009?
I worked for local or a regional investor and developer, and got the training under some really great minds.
This is through the beginnings of the crash.
That's right.
Okay.
That's right.
And where was this geographically?
It was in Atlanta.
It was in Atlanta. Okay.
Yeah.
All right.
And
is
so
that where you live now? Is that your home base?
I was there for about 15 years. I moved to Las Vegas about 5 years ago.
Oh, that's right.
now.
You told me you came in from Vegas. I appreciate you flying all the way out here. I know you got family here, but still, it's a big ask. I appreciate that.
Happy to be here. Yeah.
Thank you.
So we were working through. It was kind of southeastern focus, so not just in Atlanta, and we were working through, how do we batten down the hatches for what's going on and
Okay, so it was all in stabilization mode and enduring the storm mode. It wasn't acquisition mode yet at that point.
It wasn't. No, the acquisitions had happened, and
Right.
I cut my teeth in asset management with the hopes of getting into more of the acquisition and
Gotcha.
development side of things.
So you helped him on the asset management side through the storm.
That's right.
Talk about that.
Well, every day was different, and every day was a challenge.
How many doors and were they all in Atlanta or?
No, Atlanta, Tampa,
Oh.
Charlotte, Nashville. It was a big regional
Good
developer.
markets. Great
Very
markets.
good
Yeah.
markets. Yeah. At the time,
What
they were
asset
doing
class?
A
A class. Oh, so
Yep.
nice assets.
Yeah.
Okay.
At the time, it was more of a condo boom, and so
Right.
they did mixed-use, high-rise development in urban environments. So
Gotcha.
a lot of that was pivoting from condominiums to apartments.
Rentals. Yeah, rentals.
So
yeah.
there was great
broken
opportunity in that.
condos, right.
That's right. So there's great opportunity to pivot, change the business plan, which I got
Had
great
to.
experience in that.
You had to
That's
change
exactly
the business.
right.
You had to innovate. You had to pivot. I mean, let me speak to that for 1 second. I remember, throughout life, you may end up having to innovate or pivot as things come up. Like I remember when COVID hit, I was supposed to have 800 people in Orlando. I'm like, holy crap, I'd sold half the tickets. What am I going to do? So I innovated, built this studio, and here we are. And And don't be afraid of that, because in what's coming, you're going to see more and more of that, where you have to reinvent yourself, or you have to innovate, or you have to just change what you do. Don't be afraid of it. Embrace it and push through it, because I will tell you, the largest and the strongest companies on earth were born in the times that are coming. Okay, and it's coming. So talk about some of the things that you had to do. How many doors were you dealing with at the time? Do you recall?
Shoot, I couldn't
thousands.
Thousands of
doors. Okay, and so it was all about, at that point, it was all about KPIs, asset management, maintain occupancy through whatever means possible.
From sales, moving into a rental.
Were you? Oh yeah, pivot from condo sales. Gotcha.
To a for rent model, and then also maintaining those retail tenants at the bottom, and doing a lot of workouts on leases, adding some term in exchange for some free rent to get them through.
Right. Because retail suffered then too.
Yeah.
So let me ask you this, because this came up in the last interview you just had. Did the A-class assets, because I wasn't in that marketplace, this is for my own edification, did they suffer because people moved into lower priced solutions, or how did A-class do compared to some of the other classes in your experience going through it?
We saw a lot of demand for it.
Okay.
The demand that left entirely was the for sale, or the buyers.
Sales.
But
gotcha.
there was plenty of money in those growing Sunbelt markets, right? There's plenty of people still in those markets that want to be there for quality of life and potential job opportunities. And while those cities got hit hard in many instances, those are where the jobs are. So people were still
they still had to have a place to live.
That's right.
But as it related to the asset class, so the A asset class did okay compared to
fared well.
to
I mean,
B,
I think
C.
We didn't have. In that instance, we didn't have any exposure to B or C, so it's tough for me to contrast.
Fair enough. But certainly your occupancy dropped.
Oh yeah.
But it was still sustainable then.
That's right.
Okay.
That's right. Okay. And it was a lot of working out with the banks. Hey, this is a new model, and banks had plenty that they were working through.
Oh,
as well.
Trust me, everybody. I mean, I met with bank presidents and everything else when it was going on, and it was not a fun time. But that's what you did.
We got through that, and
you learned a lot. You grew.
Yeah, learned a lot.
Trial by fire.
That's right.
Yeah.
And I'm kind of perusing the landscape here and seeing that a lot of things are at a discount, and there's strong rental demand, and I started, in order to start myself, I had to go buy in the C class space where I could afford to and get started, and we found some great opportunities
in Atlanta.
That's right. Myself and some partners, and we started buying.
Did you JV or syndicate?
Syndicate.
You syndicated.
Syndicated as a start. We had one investor to start, and that believed in us, and the first deal was a success. So the next deal we added.
How big was the first deal?
36 units.
36 units.
Yeah.
Bam.
Yeah.
Okay, guys, wait. Drum roll. What was it per unit cost?
It was about $23,000.
$23,000. Oh, good God.
Isn't that crazy?
Oh, good God. Oh, to have those days again. Yeah.
Right.
But wow. Okay. So you syndicated. Let me ask you this. So keep going. I'm sorry. And I'll interject here in a second.
Sure.
I have a question, but I'm going to wait a minute.
With each success, we were sharing to our network of family and friends. And
okay. That's what I was going to ask you since you said that. How did you build reach? Did you have a meetup group? How did you build reach to find more investors to go do more deals?
It was more organically as I look
just
back.
Networking, family and friends. You didn't create social media wasn't really around, but a lot of the operators that have had your door counts and higher, sitting in that chair, did meetup groups or real estate investor club meetings.
I would go to some of those and kind of share our successes and what we were seeing,
gotcha.
But a lot of it was sharing our success with friends and family that then got interested in it. They saw the opportunity. People were scared to come out at first because, everything's down.
Well,
that's when you want to buy.
Back then, the news would say, "Oh, real estate's going to be terrible for 10 years. Don't get into real estate," which was crap because, multifamily rents exceeded pre-crash levels in less than 3 years from the crash. So,
and you could buy cash flowing deals,
right?
And it wasn't this super competitive environment where everything was bid up to a point that it no longer cash flowed, and you would have to do a heavy repositioning.
Which has been the last 3 years, right?
Right. So you were buying cash flowing assets, and you're going, well, these rents are below market, and I don't have to put a lot of money in. I just turn a tenant or at renewal,
or just get the occupancy up.
That's right.
You know, I had some apartment complexes here in Florida, and I crashed and burned because I had 800 houses. It was the houses that pulled me down, and I was only at a 30% loan to value, by the way, which is
Really?
shocked people. Yeah.
Wow.
But houses just don't cash flow. I don't care what anybody tells me that
Sure.
and these were C-class houses, so a lot more maintenance, tougher on the properties. The maintenance is what killed me.
Yeah.
But my apartments pulled back, I don't know, 11, 12% in occupancy. I mean, it wasn't the end of the world. They would have easily survived if I hadn't cross-collateralized them with packages of houses. But so you started buying.
Yeah.
Syndicating and just networking family and friends to raise money for your deals.
That's right. And we'd do a bigger deal each time.
Right.
And it snowballed.
And this was with some partners?
Yep.
How many partners?
2 other partners.
Are they still with you?
No.
Okay. So it's just you now, or you have other partners?
No, I have other partners.
Oh, gotcha.
Yeah.
That's how it works.
Yeah.
Partnerships, the only problem with partnerships, though, is they're like a marriage. Easy to get into and hard to get out of. And
Very true.
I have this resource, by the way, if you're thinking about getting in a partnership. It's the questions you should ask before you get in a partnership, and it's on Rod's links in the free books. It's in the free book session, yes? Yep. So it's on Rod's links in the free book session, because like I just said, a lot of partnerships don't make it, and sometimes they're ugly. I've had positive endings and not so positive endings. I'm sure you've had the same, yes?
Sure.
Yeah. So ask those hard questions up front. So anyway, back to your story. Please continue. Sorry, I keep interrupting.
No problem. Yeah.
Right.
No, each deal, the second deal, we had 2 investors, right?
Okay.
And then they would tell a friend, and we would share our successes, and people wanted to get more and more involved, and things started thawing out a little bit too. So people wanted to jump in that class. It happened to be at a time where my network was starting to make some money too as professionals and looking for places to put it.
People you went to school with
market.
and so on and so forth that
That's
you
right.
knew, just peers. Gotcha.
Yeah.
Mm-hmm.
And with each deal, we were conservative in our underwriting. We bought right, 23,000 door, things like that.
Right.
So we would beat expectations.
Right.
And that is the best marketing you can have. People are talking about you at cocktail parties.
When you have investors and you tell them they're going to get 8% and they get 8.1%, they are thrilled. They get 7.9%, you're the Antichrist, okay?
That's right.
You have to underpromise and overdeliver. You agree with this, yes?
Absolutely.
Yeah. So very cool. Okay. And then it just grew, and now you're 4,500 doors.
Yeah.
Boom, baby.
Yeah, the next step from there, from syndicating to friends and family and then getting referrals, then you take the next step and you start working with some family offices or private equity.
Oh, so
once
you've
you have
done
enough
some of that as well.
Oh, yeah.
Okay.
Yeah. And, you've got capital brokers that have those relationships and can help walk you in and introduce you to those people as well.
So let's stop there for a second. I've not worked with a family office or a private equity yet. I'm about 5K myself. So I've heard, you hear good and bad.
Sure.
Can you talk about the good experiences, but also some not so great experiences in dealing with these larger organizations that have a lot of money and the control component, or if that came into play?
We haven't had too many bad experiences with family office or private equity. I think it's really important to make sure that you're on the same page when you enter into these. Now, private equity is typically more expensive.
Right.
And I have heard stories where, because of their fund parameters, hurdles, whatever it might be,
force a sale.
They may force a sale, and that's not.
We bought an asset in Lexington that was the exact same scenario. The guy didn't want to sell. He was pissed that he had to sell.
Yep.
His private equity made him sell.
Yeah.
And so
some of that's going on right now.
Well, sure it is. You know it's
done
going
with
on
this ride, right?
Yeah, you know it's going on right now. But so you didn't have any negative really experiences.
We had an experience when we were new to the capital broker business, and this capital broker had promised us, "Hey, I can absolutely raise the money for this, but I need for me to go do my work. I need upfront money." And so we ponied up for that, and he was not successful.
Yeah.
And so that was a hard lesson learned.
It's called a seminar.
Yeah, exactly.
I had a $50 million seminar, so don't feel bad, but that's what it is. It's a seminar. Okay, got it. Yeah, I don't like putting money up front, not unless it's proven concept with referrals and everything else. Yeah, in fact, we just got hit up by this outfit that supposedly they will do a huge line of credit for you if you put money in an account, and once they fund the first deal, you can get the money back, and it just smelled to high heaven. And I've had attorneys look at it, and yeah, just a very dubious it looks too good to be true. It walks like a duck, talks like a duck. It usually is a duck.
There are tried and true traditional structures, and those are where I would recommend.
Thank you. There you go. There you go. Good answer. Good answer. So I know you've got you're doing an opportunity fund just like we are.
That's right.
So let's talk about your view on the current economic situation and what's coming, and why.
Well, I think there's going to be tremendous opportunity, like you've said on this show and many of your other ones. When people, sponsors, equity were chasing deals at sub 3 caps in low interest rate environments, and you had 14 months of straight interest rate increases. I think there's a lot of distress from that, and we're seeing it in certain deals where the package from brokers is, in some instances, sizing the purchase price to what the seller's debt balance is.
Oh, sure.
So meaning
a lot of that right now. A lot of that, and it may not be enough.
It's not in many instances. So we've seen some where we're just saying, I can't get to that balance.
No.
And so
it's gonna have to go to the lender, and the lender's gonna have to discount it, and then there's gonna be opportunity. Yes.
Right. That's exactly right.
And that's what happened in 08 and 09. And these lenders, they're not in the management business. They don't want assets on their books, banks, and so I'm sure you've seen the news. There's some big players that are in trouble.
Very big,
like 20,000 doors in big trouble. 5, 6, 7,000 doors, and even some of the big $1 billion outfits are handing keys back over.
Yeah.
And
this is just the start of it. With all the maturities, I saw an article about
1.6 trillion due by the end of next year. They either have to sell or they have to refinance. Neither one look really great right now.
Right. And a lot of those refinances are requiring
money in, and a rate cap.
Yep. Yeah, which are very expensive.
They're insane. I mean, I tell the story. I read an article, and $100 million rate cap in 2020 for 3 years, and 3% was $23,000. This was 6 months ago. It was $2.3 million for the same rate cap, and that was only for 1 year. Forget 3 years.
Wow.
And so I know you've heard it on the show before, but I'm going to mention it because Cameron hasn't heard it. I've got an SEC attorney in Dallas that half of his, and he's a big one, half of his business now is forbearances, capital calls, and foreclosures. Half of his business dealing with his clients that are in trouble.
Yeah.
And bridge debt. Speak to that scenario with people that use bridge debt these last few years to get a higher LTV or whatever. Right. It's not what it was for. Bridge debt's supposed to bridge the gap from a non-performing asset to a performing asset,
right.
And people used it to ramp projected returns, not anticipating what's happened with rates. And boy, we've seen we're bidding on a place right now here in Florida that their loan comes due in 3 months, and their interest rate's like 8.3% right now, and I'm sure that's it. When they bought that place, it was in the 4s. So
hopefully they've done a good job of executing their improvement plan, right, and pushing the rents.
We like the deal. I think it'll trade. And Florida's so hot right now. It's just the damn insurance here that's insane. So where are your assets now, by the way?
Our holdings currently are in Atlanta and Charleston, South Carolina.
Oh, great markets. Both of
Very
them great.
Markets,
yeah, love it. So we're both in agreement that what's going to hit the fan here at some point.
That's right.
We're going to see some pain, but we're going to see some opportunity. We're going to look at it through rose-colored glasses. Yes.
That's right. Yeah. I think you'll see discounts similar to what we saw during the Great Financial Crisis.
I agree.
I don't know if they'll be as deep, but it's going to be the best pricing we've seen in years.
That's right. Best pricing we've seen in years. Yeah. So talk about some of the strategy around remaining conservative and diligent through this process. So let's start with underwriting. Talk about your underwriting strategy as we move into this, because it's not a time to be aggressive.
Yeah.
Right?
So anytime we've underwritten, and this is how we were able to underpromise and overdeliver.
Right.
So if we are showing you rents of $1,500, I typically feel very confident that I can get $1,650. But I want to show you $1,500 because then I feel really good that I can hit those.
Yeah.
Same thing with operating expenses. I usually have a little bit of padding in there. Just as well over these last few years with inflation that blew out. Who could have seen costs?
Have you bought in the last year?
Last deal we did was September of 22.
Okay.
We had put that under contract.
And then prior
March,
to that,
April.
when was the last deal you bought?
We had bought some stuff January, February,
so-
and March of 22 as well.
So you bought some stuff early in 22 and then September. Yeah, we only bought 2 deals in the last 18 months.
Okay.
Yes. But both deals were 8 pref 50-50, not 70-30, 80-20 on the tail end. I mean, they were that good.
Right.
So, but I've been probably a little too conservative, but I think it's gonna wash out okay based on what's coming. So, 10-year debt fixed, we're golden on those. Yeah.
Good place to be. If you've got cash flow in place, your
Better
investors
believe
are
it.
happy.
Yeah.
Love mailbox money. That's why a lot of people get into this
Right.
investing in real estate, right?
Sure.
So,
Sure. So you underwrite very conservatively. You look at some of the pro forma numbers, and you decrease the rent, you increase the expenses to.
Sure.
Any other stress testing that you do when you underwrite?
Absolutely.
Talk about that.
Capital improvements. We're very heavy value add focused.
Right.
So we typically have worst case scenario on construction, and then we add a contingency to that.
On top of that.
Yep.
Which sometimes happens. Okay. All the
especially
time.
in the last few years with
Right.
pricing. So it's
Thank
just
you.
as well we had
Supply
all of
chain
these-
issues and all that crap. I mean, yeah. So good. Okay, good. So you
And
do it
then-
on the CapEx. What else?
Expansion of cap rate.
Right.
And if cap rates compress, great. Then
Right.
then your investors are going to be singing your praises.
Right.
But and if the deal works with that, then okay. Then
So what he's talking about is when you take your pro forma out 5 years, you project a higher cap rate than what you bought it for, even though it's a very good argument that the cap rates will come down because the interest rate should come down. But who knows? But if you're projecting a higher cap rate, I don't know, what do you do? 15, 20 basis points? What do you do typically?
Yeah.
Around there, yeah. So 100 basis points in 1% of interest. Okay, so 15 basis points is 15% of 1%, and you just do that a year, and like he said, if the cap rates come down, then the investors are thrilled. If not, then you've been conservative, very conservative.
Sure.
What else?
We've got a deal right now where we've done. We're modeling a 3-year hold, but we're doing a full point in expansion over that time frame, just because
could very well be. Who knows how things are going to shake out here? I mean, it could very well. They could raise rates some more next year. I mean, these things.
That's
you
right.
just never know where they're going to go. Nobody expected what's happening right now. Nobody expected some of these huge players, not just in office. Of course, office is a complete, what show right now, but in multi, there's hotels. They're handing these things back, and in my view, we're going to see some more bank failures because a third of this commercial debt's held by small and regional banks, and of course, you saw these idiots in the current administration putting further limitations on the larger banks in commercial. I'm sure you've seen the press about that. It's kind of interesting how it's all shaken out here, but I think we're going to see more bank failures. I don't know what you think, but unless they print another $2 trillion to take care of this debt that's maturing, right? God forbid if they do, then we're definitely going to have more interest rate increases because inflation is going to continue.
Then we get back to those teens.
Yeah. When I was 18 and I got in this business, the interest rate was 18%.
There you go.
Okay. And I bought real estate then. I mean, the numbers, they talk about the 1% rule in the single family space. You can rent it for 1% of what you paid for it. I was renting at 2% of what I paid for it. I was buying houses for 20 grand all day long back then.
Yeah.
It was a lifetime ago. But
pricing changed since then.
Yeah, just a little bit. Yeah, just a little bit. I'll tell you a funny story. I had this asset in Denver, this house I bought. I bought it for 57 and sold it for 77. It was a flip. The market crashed. I bought the same house back for 18, okay? Sold it, I don't know, 7 years later for 160. It's now worth $1 million. The area gentrified. Wow. So it's like, yeah, crazy. So that's on the underwriting side. That's super important, and I'm sure that you raise operating reserves as well. Yes,
we do.
Money in the bank.
One other thing that we underwrite too is who is our buyer. So what is their exit going to be? And
how do you meet their requirements? Right. Yeah.
And they're going to have to go through the same process we went through with lenders, and any equity is okay. Where are proofs in the market, comps in the market on the sales on a per door basis for that vintage.
You prove the concept. You leave them some meat on the bone so they can finish, and roll. You roll it to them, but you've got to look at what their capability, what their abilities are going to be. Are they going to be able to get the debt? Are they going to be able to show the numbers they need to show to be able to get you the returns that you want?
That's right.
Yes, right.
Yeah, and you have to take into account if this is what you want their exit to be, not only can they comp out at that, but you need to adjust for the taxes that they will pay. Because in many
that's
cities
really good.
Municipalities, they reset taxes based on the
Sales.
sale price.
Sure.
Now, there's certain markets that we're in that they don't. But
right. Ohio, where you sell the LLC, and Vegas is another one. No kidding.
Right.
Wow.
Yep.
Yeah, you buy the LLC, and there's some risks there, but you have to in some places. But that's really smart, and I hadn't heard that on the show before. Where you really take the time to project. If you're buying and selling, I mean, that's not our model. But if you're buying and selling, that's a really. In fact, the last guy said that though, didn't he? Now you weren't listening. Yeah, the last guy said it as well. That he does it. I'm sorry, but he articulated it a little differently. That's why I missed it. But yeah, no, that's really smart to really look at your exit, not just in the cap rate and potential interest rate increases or things of that nature, but look at your ultimate buyer's ability to help you execute your plan. Love it. So now let's talk about execution. Let's talk about how you actually asset manage in a time like this, because we talked about this briefly before we started recording, and I said, the water's going out right now. We're going to see who's naked, and they see who's wet behind the ears. That's never really asset managed in a tough time. So talk about some of the things that you're doing or projecting to do as we move through this part of the cycle.
I think a great way to summarize it is take what the defense gives you, right?
Okay.
And what I mean by
please
that,
elaborate. Yeah.
What I mean by that is this is not the time to push on rents. I think now is the time to preserve occupancy.
Number one thing.
Yep, occupancy is going to be number one. And keep in mind with rising operating costs and material costs that keeping an existing tenant, keeping your existing customer is much cheaper than attracting
your
new ones.
biggest expense, typically, besides taxes and insurance, is going to be turnover.
That's right.
And so you want to minimize turnover at all costs.
Yep, the turn costs have gone up.
Right.
And then the cost to attract them. It's a very competitive marketplace.
I'm getting
online.
I'm getting a sign spinner at our Nashville asset. I'm gonna have somebody standing out there holding a freaking sign with an arrow, says great deal, 3 bedrooms over here, and this guerrilla marketing now.
Exactly.
So that's what's coming.
Yeah.
So okay, maintain occupancy. Talk about, elaborate further on execution, right? Elaborate further on measurement and control and accountability. Speak to that a little bit, how you plan to do that.
Well, one, your ability to execute starts in your due diligence period, right?
Agreed.
So if you're underwriting, you need to understand if there are infrastructure issues, specifically with that vintage or construction type.
Of course.
And so, there's a lot of people that get
different types of PVC, aluminum wiring. Have they been pigtailed? Have the lines been scoped? Sewer lines been scoped?
That's right.
Is there a chiller or a boiler that's limping? Or if there are a bunch of HVACs? What's the age of those? All of that.
So all of those things are crucial to having happy tenants and having a well-run asset.
Yeah.
But those things don't drive rent growth. Those are standard expectations of your customer that these things work when they get there. And if you don't identify that and address it during the contract phase and the acquisition phase, you're left paying for that. And that could be out of some of the CapEx budget that you were going to use to go drive rents and drive value. So you don't want to miss on that. Then upon acquisition, you want to have your plan ready to go day one. And you want to have your asset ready to take advantage of opportunistic markets as soon as possible, because you never know when they're going to come.
Right. So do you, are you vertically integrated or do you use third-party management?
We use third-party property management.
So do we, yeah.
But we have in-house construction and asset management.
Okay.
And it's very hands-on.
Yeah, okay. So you're doing your construction in-house, you're doing your turns and all that.
We
well,
do
not
that
your
with
turns as much, I suppose, but your CapEx. You're doing your CapEx in-house?
Depending on what the project is. But
I see.
Typically, we have third-party vendors, but our construction management team is very on top of these and meeting them on the asset and saying, this is right, this is wrong.
Gotcha. So you have a construction management team that manages local assets to make sure that it's done properly.
That's right.
That's right. Now, that's a great way to do it. That's a great way to really have some controls in place and whatnot. Now, let's talk about on an ongoing basis, as you're asset managing that asset and you're managing that property management company. Talk about how you get through that.
Sure. I think upon acquisition, you're setting the expectation of, okay, this is what we've modeled. They've signed off on the budget, operating budget and CapEx budget, and what the plan is. So we're aligned on a vision day one. From there, we have 2 calls a week at least, standing calls that talk operations and then that are also doing rent pricing. And what it does is we get to understand what the issues are, what the challenges are, what their wins are, and celebrate the wins with them so they know that we're aligned with them. We also get to see what the occupancy is in the market and trends in the market when we're looking at pricing calls and what our comps are doing.
What asset class are you in now primarily?
We typically buy like a C plus B minus and try to get to a BB plus.
Yeah.
We underwrite with some metrics as far as affordability. Naturally occurring affordable housing is our target. Some discounts to average mortgage prices in the area, and predominantly our tenant base, our customer is going to be a renter by necessity. And there's a stickiness to that. But these renters by necessity at this price point are also the backbones of our community, right? They're educating our children. They're providing health care.
Yeah.
And so we want to show them value, and we renovate to an A-class scope on the interior. You know, we're not the A-class high-rise that just came out of the ground, but our interior finishes look very similar.
Really?
And our amenity package is...
So you really want to be the best in your asset class in your submarket.
That's right.
Yeah.
And so we want to be very close to employment and entertainment hubs. And a lot of times we are in the same neighborhood, even on the same street as an A-class, whether it's garden style or high rise.
Right.
And we're hundreds of dollars cheaper.
Right.
And so that proves robust for demand.
Sure it does. No, that's good. That's good. So you have a couple calls a week, and talk about, let's go a little micro, just for the listeners that don't understand what happens on these calls. Talk about some of the different things you're looking at each week.
We want to look at our current occupancy and future trends. We want to see...
Renewals.
I'm sorry?
Renewals.
What's our renewal rate, retention rate? What is the lease trade out on that?
So on the renewals and lease trade out as well. Let me explain both those things so you don't know what that means. So on the renewals, you're going to want to have at least a 3-month window moving forward. How many people's leases are expiring and what's happening with those leases? Okay, well, 2 of them have notice to vacate. They're going to leave. 3 of them have renewed. And the market trade out is what's the new pricing you're getting for those units that for the people to stay, and how close is it to the market there, and so that's what he's talking about. And then there'll be some that haven't decided yet, but that's something you want to track very closely. Please continue.
That's right. And we look at the reasons why people are moving out.
Oh, very important.
And they will be candid about it, and they'll say, I'm unhappy with service. And so the asset that we bought last September that we were talking about, I set the expectation. I'm going to go through and understand why are people leaving. And when it's unhappy with service, I'm going to ask about that.
Oh, yeah.
And, it was actually some things beyond their means. The previous owner had rented washers and dryers for those units, and the third-party vendor couldn't service them. People were frustrated that their washer and dryer couldn't work.
Yeah, that's a big deal. It's a big deal, for sure.
Part of our CapEx budget was to buy washers and dryers. Well, let's first put those in our existing tenant spaces and retain those tenants.
You better believe it.
So
good.
And it shows them that we're not just
raising rents. You're not here, the new sheriff in town, just to raise rents and make your life hell. Right. By the way, whenever you buy an asset, ideally you're making some exterior improvements, that everybody sees, that you really care about the place. You do all that before you start pushing rents. Okay, you let them see correct.
That's right.
Yeah.
See the value.
Right,
Yep.
right.
And so our feedback was very quickly that these owners care. They're making improvements, and
Right.
that they were happy here.
Yeah.
Some were beyond saving because they were just so frustrated.
Right,
with the washer
and that
dryer.
happens.
And that's okay.
Yeah, nothing you can
but
do
at
about
least
that.
they and some of the comments in it were, hey, the property manager was great at following through. She, not her fault at all. We just found a new place in that time frame. Honestly, we like the trajectory of where it's going. So we also recognize the staff for doing a great job. Hey, you couldn't save this person, but look at the customer service you're providing. And I think that's a lost art too.
Sure. Yeah, we just bought an asset. Not just bought it, but we have an asset in Nashville. And the comments online were always, the maintenance guys are great. They just don't have the parts they need because the seller wasn't providing the money to buy parts. It was ugly. And so, you've got reputation management you've got to look at as well.
That's right.
By the way, as a little tip, I don't know if you've introduced those pop cards. Do you have those pop cards? You know what I'm talking about? It's like a card that anybody with an iPhone can scan, and it goes right to the Google review for that complex.
Okay. Yeah.
So yeah, I'll get you the link for that, because
great.
it's been a game changer. Because when somebody's moving in, or they've just had their problem handled and they're in the office and they're like, hey, can you take 2 minutes to scan this and just say some nice things? It's been awesome.
That's a great way to get there,
Yeah.
because we often ask for
Right,
for
right,
reviews,
but then they don't do it. But if
forget
it's right
about
there
Right.
and you can scan the card, I'll get you the link for that. But anyway, so that's an important piece. And so we're talking about the asset management piece here again. And by the way, is the asset management book in the books or no? It's not. Okay, all right. I have a free book on asset management that's kick-ass. If you DM me on any social channel and say asset management, I'll get you the book. It's like best in class. It's really good. It's like this. It's like 2 inches thick. But to further the education here, so you're looking at renewals, you look at open time on work orders, I'm sure as well, yes?
Right. Yep, units turned. How long is it taking to turn
How long
units?
does it
You
turn?
don't want them down.
That's right. Hugely important.
Yeah.
A week matters, okay? Like if it's a difference between 1 week and 2 weeks, that really matters when you carry it out over the year and you see how much rent you're losing, right?
That's right.
Yeah.
Yeah. Looking at your online resources, which are the most effective, and where should you be?
The marketing resources.
That's right.
Yeah.
Where should we be putting
Doubling
more
down
resources,
and
and where should we pull?
Yep. That's basic marketing there. Good. So you're tracking that. Do you track the lease process? Like, okay, lead comes in. How long was it before they responded? How many resulted in showings? How many of those showings resulted in apps, and how many of those apps resulted in leases?
Absolutely.
We
track
do that
on
too.
the call.
You look for breakdowns in each one of those sections, right?
Exactly. And it's incredible how quickly how pivotal it is that you respond in a timely fashion, because
Critical.
people are looking for a place, and they're going from place to place to place. And if you can answer within 10 minutes or right away,
Right.
you've
Stopped them. Yeah, you've stopped them, and they're going to come look at your place. You know,
right.
that's critical. That's a critical piece.
responsiveness is
And you can see whether or not your leasing agents really care.
That's
you
right.
know, my ex is getting a place here in Sarasota, and I was with her helping shop that, and we went to this one beautiful asset, and man, we couldn't get the guy. The guy didn't even want to show us units. He's like, yeah, we really don't have anything good. All the hours real small, and it's just terrible. Then we found out that it was owned by the bank. It's owned by Deutsche Bank. Like, well, there you go. They don't care. So it was fascinating.
There's a buying opportunity.
Well, there you go. No, I've thought about that as well. And you know, that on-site presence, you know, the leasing agents, the property manager, by God, when somebody mystery shops, you better see them jump out of their chair to say hi and smile and greet you, right?
That's right. Absolutely.
That's what we want. And then, of course, you're looking at late pays. You're looking at evictions. You're tracking that every, you know, and these are the weekly calls. This is the kind of stuff you're going through, guys. What am I forgetting? You know, collections, of course. What are the collections for the month?
Sure.
You know, how does it compare to last month? And of course, you're looking for any anomalies, any exceptions, anything that's out of the norm you have to deal with, crime, things of that nature.
Yep.
Okay.
Problematic tenants.
So that's execution. So now let's talk about raising equity. You know, it's becoming harder and harder because you've got these onerous, you know, news articles about how horrible things are, and that things are going to get bad. And there's going to be some investors that lose their money, but there's, again, also going to be exponential opportunity. How do you communicate that? Well,
Sure.
I think I know the answer because we're both doing the same thing, but go ahead.
Right. Well, the basic thesis of investing is buy low, sell high.
Thank you.
And so right now, that is what is happening.
Right.
And it's just starting to happen.
Right.
But I think there's going to be a lot more of it with all these debt maturities. And, as we talked about, people paid very aggressive prices, and they weren't necessarily, they didn't hit their pro formas, whether that was through execution or more of a macroeconomic issue. And so a great pricing reset will allow somebody else to have an incredible asset. And, I think there's another opportunity here to provide working class affordable housing for people, because if these prices are reset, they got so frothy in some ways that people had to raise rent so much. But
rents have been insane. I mean, like in, was it 21, Tampa went up over 30% in one freaking year.
Yeah.
I mean, crazy. And so
people underwrote to that, which is
I know.
incredible to me.
Right.
I don't know how that passed mustered with.
it was lenders, right?
Yeah, I don't
same
know how
here,
that
same
happened.
here. So raising equity is going to be more challenging.
Mm-hmm.
What are your thoughts on that? Let's elaborate on that a little bit.
Yeah, people are very cautious.
Right.
Family offices, private equity, they don't want to lose money. I think you have to be able to demonstrate that you are getting a great discount
Right.
and a great asset. And I think your track record is
Sure.
going to be incredibly
Important
in this.
But
time
even
too.
with retail investors,
Mhm.
you're talking about family offices and private equity. Do you work with retail investors as well?
We do.
Okay, so I'm sure you're seeing it's much harder now. A lot more phone calls,
right.
a lot more hand holding. Yes,
Yeah, absolutely.
And back you could have a webinar and a deal and be fully subscribed fairly quickly. Now it's a lot of hand holding and whatnot.
There's more questions, but
Mhm.
we've always been very hands-on with those investors, any investor. And
Right.
An investor say, sorry for taking up your time. And we say, no, an educated investor is your best investor.
Thank you.
Here is where the risks are. Here's how we mitigate them. We can't guarantee returns.
Right.
We've been proud of our track record that we've never lost investors' money, and we're cautious and
Same
want
here.
to keep building on that.
Of course.
But we can't live in absolute guarantees.
Right. Of
And
course not.
so if we can educate them on the process and hey, there's bumps in the road. We're seasoned. We understand how to handle them.
Mm-hmm.
And here's what we do when these things come up. The other thing I think has been important in this time is to be very transparent in the assets that you have. And hey, we're seeing some
Even if it's
challenges.
bad.
That's right.
Yeah.
So we see some challenges with oncoming supply, and it's creeping into our market because they're
Mm-hmm.
offering two months concession on brand new A-class product right now.
Right.
And that's a reality.
Yeah. So we may cut rents a little bit temporarily.
That's right.
Until we get through this. Yeah, that's actually happening on our Nashville asset right now. So
Yeah. Preserve occupancy.
that's
right?
it.
We want
Occupancy
it
is everything. Yeah. Okay. So but that communication is critical with your investors. That ongoing communication. I assume you send an email at least once a month.
That's right.
At the very least, like we do.
full.
Yeah.
We do monthly updates and then a more robust quarterly update.
Yeah, and like maybe a webinar or something, show behind the scenes, show some pictures, some of the things that were done. We do that as well. I try to educate a little bit behind the scenes as well, because that's what I do.
Sure.
And so I incorporate that, and I think investors appreciate that, and I'm sure you do the same thing, a little bit of
The
education.
feedback has been, we appreciate the transparency and
Right.
the constant communication, and it
Right.
builds trust that you're doing what you said you were going to do.
Right. And
They
you're
love
on
to-
it,
they
and
love
you're
to
on,
see
and
the
you're on
progress.
it. You're
That's right.
paying freaking attention, right? That's
right.
super important.
Yep.
And so I know you've just put together a fund. Yes, this
That's
is
right.
this is at the stonemarklandings.com, and and it's just distressed asset opportunity fund. Yes,
That's right. We're calling it the Opportunistic Value Add Fund.
The opportunistic value add fund. Okay, I like that.
Yeah. So, over the past cycle,
Right.
as I alluded to earlier, it used to be you could buy at cash flow day one. Then
Right.
it got into, well, you have to be really good at executing
Right.
to hit your pro forma projections.
Sure.
And now I think you can combine the best of both worlds, right? You take your ability to execute and reposition an asset, you combine that with discounted prices because of the distress that's coming.
Right.
Basically buying as the wave crashes and riding the next wave. As you said, we're going to surf this next wave.
Right.
And our intent is to buy about $300 million in assets across Sunbelt and Mountain West markets that we've lived, worked, played in, that we understand. that are growing.
This is where you and your partners live, work, and
That's right.
and whatnot. Yeah, that's
right.
great. Mm-hmm.
So we're focused on those markets, and it's modeled as a 5-year hold, which theoretically should be early to mid-cycle, plenty of time to get out. We're happy to leave meat on the bone for the next buyer, as long as we are hitting our projections and or exceeding them, as we've built our reputation on.
So your model is buy and sell. Your model is not buy, refinance, and hold.
We will refinance as well,
Okay.
and we've done that in this model. There's a couple exits, right?
Yeah.
You
always have that.
That's
you always
right.
have that. But I love holding. I hate everything I've ever sold or lost in 2008 and 9. So I love to hold personally, but it's not always possible. So talk about, everybody thinks it's all gravy. You've been in 4,500 freaking doors. You're going to have 5,000 more by the next time we talk. And so talk about some of the setbacks, some of the seminars, failures you've had, because everybody thinks it's all rosy and there's never, I'm sure you've got a menu of them to choose from, but talk about one that maybe that'll impart a lesson, something you learned. Anything come to mind?
We did a deal that wasn't necessarily in our expertise or wheelhouse. We took an apartment community and repositioned it into for sale condo.
You did a condo conversion.
We did a condo conversion.
Okay.
And
when was this?
We must have bought it 2018.
Okay, so
and cashed out around COVID 2020ish.
Gotcha. Did you beat the COVID? Did you cash out before COVID?
No. Through kind of the end of the year. So. Yeah, but there was still demand for home ownership, but it wasn't our core.
Right.
It wasn't what we understood, and we overbuilt.
So meaning the amenities were too much. You spent too much money making,
and we should have done a more affordable product, and it would have flown off the shelves quicker.
Right.
We had also in our back pocket, we had 9 townhome lots that we could sell. That would be an extra juice that wasn't included in the model, and it was fortunate that we modeled that because
you ended up needing it.
We ended up needing it.
I gotcha.
But as the last condo sold, the Atlanta BeltLine came in and said, we think we're going to come right through here to connect. And if you're an apartment owner, if the BeltLine comes through in this market, those that know the Atlanta market,
showing, baby.
Yeah, that's a double-digit increase in value right there on your rents and exit. So, a lot of lessons learned there was to stay in our wheelhouse, stay in the for rent product.
I wonder if you could have found out about that if you had a little ear with the municipalities, because one of the things I teach at my boot camps is pay attention to what's going on, with zoning, with things like that, because it can be a positive or a negative. If they're putting in new sewer lines in front of your complex, guess who pays for that? Or water lines or whatever, new infrastructure. So, but in your case, it was definitely a positive. Wow. Well,
that's right.
Woulda, coulda, shoulda.
That's right.
Yep. I got stories like that. That one time I had 500 houses in Denver. If I still had those, they'd be free and clear, and I would be bottom line netting $1 million a month right now. Bottom line net. And we wouldn't be having this conversation. We would, but it'd be on Zoom on the back of my yacht.
That's right.
So,
well, we talk about what the cost per unit is.
Now we paid in the 20s, right? And
yeah.
I mean, it's crazy.
Some of the stuff you sold, and yes, you recycled that capital. But if you had it,
and I'll tell you, I don't know about you, but I have mental pushback sometimes when I see the pricing, and I remember that. Mm-hmm. It's hard for me to recognize that the dollar is devalued so much that it's not as bad as it looks when you look at it at first blush. Does that make sense?
That's a very good point.
Yeah, yes. But I mean, just what's happened with inflation in this country. I mean, I remember 24 cent gas, 24.9 gallons of gas when I was a kid, and hamburgers for $10 and fries for 10 cents and 5 cents. I mean, this is how old I am. So, wow. So anyway, so you're putting this fund together. That's fantastic. And so are we. Very excited about it. I think there's going to be lots of opportunity. So Liz, you've been very, very successful. You'll continue to be very successful. So a lot of my listeners, and I've got a lot of seasoned listeners as well, but a lot of my listeners haven't actually taken the plunge yet. You know they want more out of life. They know they deserve more out of life. Speak to those people. Speak to them. You know, inspire them a little bit if you could, please.
Yeah, I mean, I wish I would have done it sooner, and I got out pretty early. And everybody I've ever spoken to, that's the same thing as I should have figured it out sooner. I should have taken the jump.
Yeah.
And I always wanted to be an entrepreneur. It was just my calling, right? And I remember when I finally was able, you know, we had bought enough assets that, okay, I can go take that jump. Right. And I thought that would be such an easy decision and the happiest day of my life. And it was very happy. Right. But it was scarier than I thought it would be. Right. And it's just that
to give up the W-2.
That's right.
Right. Yeah.
And it was shocking to me. Why am I scared? You know.
But let me say this, and those of you listening, you don't have to freaking give up the W-2. In fact, you call me. I get a call this all the time. Should I quit my job and do this full time? My answer is always no, because I've got students that have built, you know, super successful. I mean, they've retired from their W-2s, but they built what they did, you know, on the side with families, with kids, with a consuming W-2, and they were still able to do it, you know, to get going. And so, don't quit your job. Just there is that. But do get your butt to my boot camp in September, for God's sakes, because it's coming. Okay. Hopefully this will air with enough time to give them that impetus. But it's you know, like Cameron and I both say, opportunity is knocking right now.
That's right. And what's important, and you're talking about your boot camps, is understanding what you're investing in. So you need to understand the process and how to underwrite deals. You can't just trust anybody. No. And
even if you're going to invest passively, candidly, you know, you should have a basic understanding. If you want to invest passively, you don't want to do this as an operator, still get your butt to my boot camp, because, you know, it's 3 days. It's not a big sales pitch, and it's just full on training. And I tell people, it's like, why would you give your hard-earned money to someone without having some basic understanding of what it is? Right. I mean, people do it every day with, you know, these stockbrokers that are just glorified salespeople. Haven't got a clue what they're selling you. They're just glorified salespeople. And so it's really important, I think, to self-educate a little bit, regardless of whether you want to be an operator or a passive investor. Would you agree?
Absolutely.
Yeah.
You know, there's certain sensitivities that you should be aware of as a passive investor. Sure. And how does that affect this model? And if you ask those questions, you should feel
things
a lot
like
better
debt,
about
maybe, huh?
Right.
Yeah.
What is your annual rent increase? What are you modeling?
Right. And I saw. I don't want to throw him under the bus too publicly, but his initials are GC, and he promoted 10% rent increases for 5 years. This was last year.
Oh boy.
Yeah.
Wonder how those are going.
Yeah, right? Yeah, I mean, he buys the best of the best, you know, and he's smarter than me. He's got a jet and a helicopter, but the point is 10% a year. Good Lord, come on. Right. That's, I mean, we're at, you know, 3% at best still today, you know, with what's happening economically. I don't know where you're, I mean, in fact, 0 year one, and then we go to 3%.
Yeah, we're
about the same.
Yeah, we're showing no organic rent increases in year one, and
right. Same here.
Year
same
two
here.
is maybe half of what we would expect.
Just try to bring us to market, you know, and that's it. Yeah.
Yep.
So talk about some of the best advice you've ever gotten in this business.
You know, I think it goes to trust but verify. And that goes to the execution piece. That's why we're so hands-on with our team. That's why we have to dig into all the data and make sure, is what you're telling me accurate? And do you understand the data right? It's not necessarily catching your team's misleading you. Okay, maybe I interpret this differently, and this is the way I see it. And then you can educate your teams on how you look at it, how we're looking to move the needle and get them on the same page. And I've said this before on podcasts, but I always tell our property manager that they are the CEO of a multi-million-dollar asset. Oh yeah, and they need to act like that, and they really are. Yeah. And they will make or break your asset. The property manager, the maintenance supervisor are mission critical to.
Absolutely. If that property manager is not getting her butt out of her chair and walking that complex every day, that's a problem. Yep. You know, with a critical eye, with eagle eye, you know, that's absolutely critical. In this journey of yours, were there mentors that you leaned on? And if there were, can you speak to that a little bit?
Absolutely. I mean, I got to work with, I had a great mentor, our CEO at the first company I worked for, the Investment and Development Group. And then I got to work for some international institutions such as CBRE and JLL and see how they looked at things.
No kidding.
Yeah.
What were you doing for them?
One was consulting on the highest and best use for state-owned.
That's right. I saw that on your the governor of Tennessee got you going there.
Great experience.
Wow.
And then CBRE, you know, and just working on the asset management side of things and how people are underwriting, how people look at things. So I got to, and I've kept in contact with so many of these former mentors or colleagues of mine.
Industry leaders.
That's right.
Right.
And,
I mean, you were at IMN, so obviously you got the memo that you need to be at events like that if you're going to be in this business.
That's absolutely right.
Yeah.
So, I love to hear what our colleagues are seeing and how they're looking at things, what's their strategy for things, keeping an ear to the ground so you're ahead of trends before they're reported in mainstream media. I've used that network of mentors, colleagues, vendors to solve problems, and that's part of having experience in this business and being able to. Nothing goes as planned, as we've said.
No.
And so having a seasoned professional at the helm helps ensure that when those problems arise, they've either seen it before, or they know who has and can help solve it for them.
They know how to execute on issues like that.
That's
Yeah,
right.
That's kind of where I come in as like a troubleshooter, and it serves me, and I actually enjoy it, frankly. But talk about your team. So you've got new partners now.
Mm-hmm.
Talk about the different roles that are played. What role do you play? What role do your partners play?
So I'm heading up our acquisition side and business development.
Gotcha.
Our business partner, Phil, who's located in Atlanta, he oversees construction management and asset management.
Mm-hmm.
And talking about being detailed in this approach, he's a pilot in his spare time.
Nice.
And he always says,
Well,
I'd prefer to know, as a pilot, I want to know about a problem on the ground as opposed to in the air.
Exactly.
And so the systematic approach that he takes to both of those.
Well, that's fantastic. I mean, pilots are so freaking detail-oriented, checklisted, and any business is nothing but people and systems, and the systems involve checklists and SOPs and KPIs and so on and so forth. So pilot is perfect for that role. And anybody else, or is that it?
Yeah. And then I've got Bob Howe and Wes Howe that are out of Lake Stevens, Washington, that were the Stonemark Capital side of the house, and Bob brings 50 years of experience in institutional real estate investment on a predominantly in a CFO role. So
he's super analytical.
That's right. Him and his son Wes are very analytical, very bright, constantly underwriting.
They're doing the
different
underwriting.
scenarios.
So you're finding the deals. You do the preliminary, and then they send it to them for final.
That's right.
Yeah,
that and then the ongoing accounting on it as well.
Of course,
so
that's a big piece.
yeah, and so they're constantly tweaking models. So what happens under this scenario? What happens under that scenario? And all of us are coming together and saying, okay, can we answer that question? And so there's a round table on any deal that we do, and unless we're unanimous, we're not moving forward.
Yeah,
on
it's like a oh crap. Board of directors. Board of directors. Thank you.
Yeah.
Good
Yes,
Lord.
that's
It's
right.
never pretty when you lose your mind. It's right there on the tip of my tongue. Yeah, board of directors, and that's what you want. The same here.
That's
I mean,
right.
you want to, and if any one person doesn't go for it, it's same with a hire. Honestly, when we do a hire, we have multiple interviews, and one person says no, it's no.
Yeah,
That's it, because everybody has different skill sets they bring to the game, right?
that's right.
Yeah. Well, listen, brother, I appreciate you coming out here all the way from Vegas, and it's good to know you live there, so I can ping you for a meal or something next time I'm
come
there.
on out.
Yeah. It's where I buy my watches, by the way, so I love
All
going
right.
out there and buying watches. But I really appreciate you coming in, my friend, and you've added tremendous value today, so I appreciate you.
I appreciate you for having me. Thank
Absolutely.
you very much. This
Absolutely.
has been a pleasure.
Thank you. Thank you.
So one other quick thing. We encounter so many people that are frankly frustrated. They're looking in the mirror and they're frustrated that they haven't been able to escape the rat race. They haven't been able to build cash flow to the point where they're able to have financial and time freedom with their families. And maybe they see other people buying real estate and creating, incredible cash flow, and they think, well, it's just scary. Buying apartments is intimidating. And I get it. See, that's why we created our Warrior Mentorship Program. They're our coaching students, and they've had extraordinary results. My students, I've been teaching about 5 years, and they own upwards of 140,000 units now that we know of, right? And we feel like it's just getting going. Now we're looking to grow this group and really take it to the next level. And honestly believe that the greatest transfer of wealth could be upon us right now with this current economic environment. Everything's going on sale. So we're looking for people who want to follow a proven framework, really like a blueprint or a map, literally step by step. And then they're able to leverage our systems and our incredible network to raise money and equity, to find deals and close those deals and build partnerships, really nationwide. So if you're interested in finding out more about how you can become more in our incredible network and take advantage of the unbelievable opportunities that are upon us, you can apply to my Warrior Mentorship Program by texting the word CRUSH to 72345. Or you can go to mentorwithrod.com. And what we'll do is we'll set up a call so you can check us out and we can check you out and see if it's a fit. Now again, you can go to mentorwithrod.com or text the word CRUSH to 72345 to apply, and we will speak soon.